Oh, God's sake, right. Oh, okay, I've got Jack there. Okay, welcome. A warm welcome to those attending and also to our viewers watching live on the Council's YouTube channel in Hillingdon, London. This is a meeting of the Pensions Committee and my name is Councillor Chamdal and I'm the chair of this meeting. Details of the business to be considered today are shown on the agenda, copies of which are accessible on YouTube underneath the broadcast. Please note that members of the committee will be using tablets, laptops to view agenda items. Fire alarm. We're not expecting a fire drill, so if the alarm goes off, please follow officers to the fire exits and out of the building to the designated meeting points. Mobile devices. For those in the room, please switch off any mobile devices before the meeting starts or put them on silent. Declarations of interest. Councillors, if you have a declaration of interest to make in relation to today's agenda, please ensure that you state it's pecuniary or non-pecuniary and give the reason for your interest. Members need not declare any interest in any item on the agenda where they have already listed this on the register of interest. Furthermore, you do not need to declare any interest just because you're a ward councillor or because you are a governor. Residents' feedback forms. For those watching via YouTube, if you're so minded, you can complete one of our resident feedback forms. These can be found in the information section under the YouTube video. These forms are intended to help us improve the way that we run our meetings. So now, before we start the meeting, we move on to the attendees of the meeting. So could we all introduce ourselves for the start of the meeting?
Councillor Stuart Mathers.
Councillor Labina Bassett.
Sophie Robinson, Hymans Robertson.
Hymans Robertson.
Marion George, Independent Advisor.
Dagmar Dvorak, London CIV.
Tim Pofu, London CIV.
Tony Noakes, Pension Board Member.
Roger Hackett, Pension Board Chair.
Sunny Jisa, ISIO.
Tunde Adekoya, Pension Fund Finance Manager.
Pete Carpenter, Director, Pensions, Treasury and Statutory Accounts.
Steve Muldoon, Section 151 Officer and Corporate Director of Finance.
Anisha Tedji, Democratic Services.
And then we have two members from Hampshire, one member from Hampshire and ISIO. Can you hear us?
Yeah, we can hear you. So,
Lovely, thank you. A warm welcome to Councillor Bassett as a new committee member. So welcome Councillor Bassett, and a warm welcome to Steve Muldoon, our Corporate Director of Finance and our Section 151 Officer. Thank you. So items, agenda items 1 to 9 will be in part 1 and in the public domain. Agenda items 10 to 13 will be conducted in part 2 for members only. Okay, so any apologies for absence?
Apologies from Councillor Sullivan and Councillor Banerjee.
Thank you. Any declarations of interest in matters coming before this meeting, councillors? No? Okay. So minutes of the previous meeting. Any amendment to the minutes of the meeting, or are we happy to agree the minutes? Agreed? Lovely. Okay, so we move on to part 5 of our administration report. Over to Pete.
Thank you, Chair. I'll give an introduction and then we've got Catherine here to help us answer any queries. The report summarising the key highlights from August up to August 2025. Membership has grown 17.8% since onboarding at Hampshire. We did 100% of the administration cases completed against SLA targets during the month, which is very similar to previous months. We now have 53.56% of members registered on the portal. This is inching up month by month. That still does mean, though, we've got 47% that aren't registered, and if you look at the stats, quite a big proportion of that are people that don't want to register. And obviously, it's much better for us to have them registered for all sorts of reasons. Speed of processing, data protection, and all sorts of other items. 99.99% of deferred benefit statements were produced on time, as were 99.55% of actives. We had, as everyone knows, a backlog of leaver cases of over 4,000 when Hampshire took things over. That's now down to 42, those historic cases, so that's really come down well. It's been a high month actually for communications volumes, with over 3,000 calls and 200 digital messages. We have done the McLeod underpin calculations for deferred and pensioner members, although we are having to make some adjustments for some of those at the present time. In terms of the new dashboard, there are some issues with that with Capita, and so we think there's going to be potentially up to a 6-week delay. That won't affect the fund because that affects all Capita customers, just not us. And so we're looking at that, and Hampshire are looking at that on a week-to-week basis and getting updates. We had 6 compliments and 1 complaint this month. Happy to answer any questions or pass over to Catherine, who could probably answer a lot better than I can.
Any questions?
I wanted to know a bit more about the complaint that was received, if you have that information.
Yes, thank you, Councillor Bassett. So the complaint was from a member who wanted to transfer about over £30,000 out of the fund, and the regulation stipulates that we have to demand the sort of obtain professional advice before it is actioned. So the basis of her complaint was rejected because the money she was about to transfer was over £30,000.
Any further questions? No. So it's recommended that the Pensions Committee note the funding and performance update. Are we all agreed on that? Move on to agenda item 6, investment strategy and fund manager performance, part 1. Over to Pete and Tunde again.
Thank you. What you've got here as background papers is our data up to the end of Q2 from both the CIV and from our actuaries, Hyman Robertson. Things look good to the end of June. Our funding level has increased to 136%, and that's up from 128% in Q1. Which means we're in a surplus position of 380 million at the moment, up from 171. But remember, that surplus position is assuming funding goes on for 20 years. And so we are still a pension fund that's towards the bottom of the league tables at the moment. That is not the position today. Liabilities, though, decreased by 20 million over the quarter as well. So the overall position is good. In looking at our assets, it's increased by to 1.46 billion in terms of value, which is a 3.96 rise in market value over the quarter, which is really positive for us. And, you know, if we're not to... Our pension fund is funded by 2 things. One is increases in value, and the other is member contributions. And obviously, all of our contributory body, be it the council, schools, or other admitted bodies, are all struggling for funding at the moment, and so we want to see returns as good as possible. The 1-year return was just under benchmark at 6.6% against 6.9%. The 5-year return is 6.1 against the benchmark of 6.6. And since inception, we've been roughly in line with benchmark. The CIV report sets out in more detail manager contributions and their monitoring and assessment. The actuary report from Hyman Robertson sets out the funding position in more detail at the end of June. Obviously, we will talk about the next 3-year in far more detail in part 2 of the agenda, but happy to answer any questions that members have or pass to the relevant experts.
Okay. Councillor Mathis.
Thank you, Chair. I just wanted to reflect a little on LCIV's performance table around total fund versus benchmark. I know you said it's slightly under. In percentage terms it is, but in terms of cash in the bank or cash in assets, they're significant sums of money. And I know that we've met the benchmark of 4% growth in this quarter, or the quarter that was reported, but we haven't exceeded our benchmark since inception, especially in the last 5 years. And that concerns me, partly when we want to have a lot of faith and confidence in, if we were going to lower employer contributions, we want to have faith and confidence that the funder will perform at the required 4.7% or more through its lifespan of 20 years. And my worry is, what my looked at LCIV as always, and others who are overseeing some of our performances, what is changing to not just tread water in terms of benchmarks, but to start to push and exceed them. There has been a change, there has been a positive trend, and I'm very grateful to the pool and the work of officers and others who have got us out of, and I know market conditions are slightly different as well, but got us out of that more difficult, challenging time, are obviously keeping fund managers to account as well. But I just worry this is the first time we've hit a benchmark in probably most of the time I've been on the committee, and our target is higher than the benchmark we hit in the last quarter. So what has changed and what will change to continue to drive performance, and also stabilise performance, because we're obviously in a better time with equities at the moment. That bubble, I shouldn't call it a bubble, I don't want to put any judgment on it, but that may not always be the case, let me put it as diplomatically as that. And so we're obviously looking to shore things up and stick to the opportunity we have here to cement a surplus in the fund that then benefits the pensioners and their previous employers, so that it's a more sustainable fund. I don't want us to feel too comfortable, sit on our laurels when our data says we've only just hit it this quarter and we've struggled to this point.
Thank you. I'll start in terms of this. In the last meeting and since the last meeting, we obviously had a member session in terms of risk appetites, and a lot of our fund at the moment is passive, and so we will be to benchmark. One of the things we've got in the closed session is looking at a number of options that ISIO have come up with to say, well, if we went a little bit further, what can we actually do, and what are members' risks appetites around that. So I think we'll address some of that in part two, but I think to a degree, unless I'm argued out of this, because we're so based on a passive portfolio at the moment, that is benchmark, isn't it? And so that's what we'll look at in part two.
Yes, I fully agree, I guess. You need to differentiate here between what is the asset class composition that you need to deliver the returns of your assets relative to your liabilities, and is the return of your assets outperforming the return of your liabilities. That helps you to increase your funding profile, and in turn helps you to sort of generate the returns you need to pay pensions. The second one then is, have you selected the right underlying managers to do better than the benchmark return? And as Pete just pointed out very correctly, is if you mainly, or if a large part of your assets is invested in passive investments, the objective of those passive investments is to meet the benchmark, not exceed it. But yes, we're working very closely with the team at the moment to sort of go through the expectations for the next 3 years and can report back, because you're also absolutely right in saying equity markets have performed very, very strongly. So what do we expect from here?
Just dig a little deeper on that, if I may. So we've always had a very passive portfolio, which, with a bit of activity, and I know that our active management in equities particularly struggled to perform in the last 3 to 4 years. I guess what I'm asking is, we have a passive portfolio, it meets benchmark. We haven't met benchmark until this quarter, so something must have changed in order for us to now be hitting that, whether it's that there's been a boost in one part of the equities, which we have a few more of now, and that's covered up some underperformance elsewhere, which could be the case. It could be the success of moving the property portfolios. Something must have changed, because we have consistently underperformed our benchmark for several years, and we've said that was market economics and different systems there. We've just hit it, so to say it's just passive for me isn't quite enough, if I can say that.
There are also a number of other factors at play, obviously. So, if you look at the allocations that you've got a sizable or substantial allocation to property, to other illiquid parts of the market. Some of those funds are in build-up mode, so you're still putting money in. In the build-up phase, those funds may just not meet the sort of requirements in terms of returns relative to the benchmark because they're not fully invested. So that's one reason. Illiquid assets get valued less frequently, so you can't compare on a sort of probably quarterly basis. You need to focus on the long term, which you just pointed out you're doing. So that's one element. The second element is on the equity side, where you have active managers. It's fair to say that active managers have struggled over the last few years in terms of outperforming their benchmarks. Again, I don't want to hide behind any sort of these things, but the market is very concentrated. A lot of active managers were uncomfortable to put as much money into the likes of the Magnificent Seven, which I'm sure you've heard, and as a consequence have underperformed. There is another reason if you look at your sort of more fixed income related products. Some of them have got a benchmark to outperform cash plus something. A lot of those benchmarks were set up when those funds were created in an environment where cash was 0 or less than that, and to outperform cash by 2%, 3% at that time was relatively easy. It's much harder now. So without trying to find excuses, there are good reasons why you should almost go back and say, do I want the product that generates cash plus 2-3%? Is this the risk that I've bought when I bought the product that was supposed to give me 2 or 3% in total? Now I'm talking about 7-8%, so to generate that I need more risk. The fund's still doing the same thing. As a consequence, the fund's somewhat underperforming the benchmark. So, again, I can't pin it down to one reason. There are a number of reasons. I would strongly urge you to look at a sort of medium term. Look to have and maintain a diversified portfolio that helps you to sort of navigate through whatever market environments and changes we're seeing.
Andrew.
Yeah.
Marion.
I wasn't going to comment on performance, but just generally a point about the future, which is, and I suspect we'll talk about this in, fit for the future. But this is something where LCIV will need to do quite a lot of work in the future to provide reports that give attribution. In the past, they've not been able to do that because they only manage their part of the assets. But when they're managing 100% of the assets, that is something that I'm sure you're fully aware will need to be delivered. So.
Okay. Thank you, Councillor Mather. That was an interesting question, which we will go into more detail in part 2. And we have discussed as a committee how much more we would like from London Civ as to contribute to us and come back with some more data, but we can go into more detail in part 2 for that as well. Okay, so the recommendations are that the Pensions Committee note the funding and performance update. Are we all agreed on that? Yep, agreed. Lovely. So moving swiftly on to agenda item 7, responsible investments update, and that's by Tunde.
Thank you, Chair. This paper provides information on how managers entrusted with investing the pension fund assets are implementing the ESG policies and demonstrates their commitment to ensuring it is a cogent part of their investment process. So, in terms of breakdown, we have 2 main managers very active in both engagements and voting. So LCIV, for example, on their part, through their contracted partner, EOS, attended about 264 meetings in the period. So, and there was a total of 3,929 resolutions that were voted upon. And the statistics show they voted 84% in favor of most resolutions, 10.4% against, and 5.5% abstentions. The other active fund manager was the Legal and General Investment Management, who attended 8,076 meetings, and they voted in total on almost 89,000 resolutions. So in terms of their voting for and against, they supported 75% of the resolutions and voted against the company's board 24.8%, 24.8%, and abstained on 0.1%. And part of the responsible investments as well involves engagement with various companies, and there are various examples within the paper on their engagement activities in terms of environmental, society, and governance sectors as well. And this can be some of the examples are within the paper itself. So, for example, LGIM did engage with both Shell and BP on various aspects of their environmental commitments. And if you read through the papers, you will see enough information about what the engagement entails. And thank you.
Any questions on the update? Councillor Mathers.
Thank you, Chair. Thank you, Tunde, for your report. I know the information for the engagement, the voting record is on the share drive. I know we can go to LGIM's, particularly their portal. I do think that the report still needs to show when voting against, on what grounds they voted against, whether it's environmental, social, remuneration, or governance, because it gives us a better indication on the kind of engagements going on. The examples are fantastic, and I think they look really good. But it's got to be about us getting a sense of what are the common resolutions they're voting against, because they could just be voting against remuneration based on bad performance, for example. I know that's not necessarily ESG, but that's a vote against. And I think it's things like that where it just gives the committee a clearer summary steer of, without spending too much officer time on it, just the general themes on which they're keeping the companies to account on their ESG, on their governance, on their remuneration, etc. So that would be a request. If please do discuss with the chair, and if you think that's able to be done without overcooking officer time, then that would be fantastic. But I just don't think it gives the public a sense of how the engagement is going with just the voting record. And my second point is that I've been contacted, I'm sure other councillors have as well, and I'm aware that the Pensions Board have been contacted around investment in around the kind of Palestine and Gaza, Israel and illegal settlements, etc. debate, and things happening on the ground. The UN obviously has a list of areas that shouldn't be invested in. I'm not asking for details now in this meeting, but I think it'd be really important if members could receive an update on what our position is and what the movement of the pension fund is, in order to ensure that we are staying within our ethos of, not endorsing illegal activity or banned weaponry, etc., gambling, the normal values base that we have. But as we are getting specific questions from different groups and individuals, and pensioners who are drawing from the fund and those in the pension fund, I think it would be extremely useful to get a sense as members after the meeting, just in an email of where we stand and what progress is being made.
Thank you, Councillor. Yeah, we like most of the other councils across the country are taking advice on this at the moment, but we'll get that advice out to you because it is affecting a lot of councils.
Right, on the first part of your question, so I will endeavour to sort of glean the information from the fund manager's report and provide a summary, a snapshot of their voting patterns, and especially whether it's ESG or governance and why in the next report.
Just a question to the officer. I received information from the Scheme Advisory Board. Did you, Councillor Mathers, receive anything from the Scheme Advisory Board? Can we arrange just to get it sent out to the committee members then? And if there's anything else we can pick up in part two. Okay. So the recommendations on this particular item are that the fund manager's ESG activities, that we note the fund manager's ESG activity and compliance efforts, and then note the LSIV and LAP activities. Are we all in agreement and note them? Yep. Agreed. Wonderful. Okay. So moving on to agenda item 8 swiftly, the Pension Fund Risk Register, and over to Pete and Tunde again.
Thank you, Chair. So the Risk Register just provides information on how the pension fund risks are categorized and managed. So currently there are 14 risks which are being monitored, but they are sort of separated into two different categories. So we have the closed risks. These are risks that are currently being managed and have been sort of sectioned because they are well under control. And we do have, there are 6 of those risks, whereas we have 8 active risks which are actively monitored. So this paper provides information on where we are in terms of the active risks and the closed risk. There hasn't been any change between the last committee meeting and now in terms of classification of the risk. So the most, in terms of the open risk, the most important risk right now is the liquidity on members' dealings, which is the ability of the fund to pay members when their pensions are due. This is being actively managed, And on a day-to-day basis, we produce a cash flow forecast tracking how much money we have and what is available to pay pensions. So I can say confidently that so far we're in a good place in terms of that. Thank you, Chair.
Any questions? No, I think that's pretty straightforward.
I'll just add one comment. We'll be talking about it in part 2, but fit for the future, because we don't know the rules yet, will probably become a significant risk or risks when we get to the next meeting. But at the moment, as we still don't know the legislation, that's sort of on hold.
Committee consider and agree the risk register in terms of the approach, the specific risks identified, and measures being taken to mitigate those current risks. And that we note the format agreeing the retired risks and those which remain open. Are we agreed? Agreed. Move swiftly on to agenda item 9, governance part 1, and again it's Tunde and Pete, please.
Thank you, Chair. So this particular agenda item provides the Pension Committee work plan, an updated version of it, and it does also provide a snapshot of the continuous professional development of committee members as required. So as a background, committee members are required to, at least within within the financial year, attend 14 hours of training in order to be able to dispense their duties as committee members. So the spreadsheet attached does show where we are right now. So we are about halfway through the financial year, and anyone with green against their name shows they are on the way to achieving that, or halfway point they have achieved it. Yellow means they're on track, and red is lacking. So, but unfortunately, we do have a couple of new councillors who have about 6 months to get up to speed with their initial training efforts. In terms of the work plan, we have updated the committee work plan to include a review of the conflict of interest policy, which will be brought to the March 26th committee. The funding strategy statement, which is here today for notes by committee, but will be taken out after today's meeting to all employers for consultation and brought back for ratification in December. Then the investment strategy statement, which will be a byproduct of the FSS, to be produced by EZIO, and that will be brought to committee again in December, and an update to the training policy in line with the Fit for Future. So again, we're aiming to get that ready before the 1st of April, so we're looking at the March 26th committee. The other important updates to give is regarding the GCOP, which is the General Code of Practice compliance. So the compliance was supposed to be effective in September 25, but unfortunately, one of the cogent documents underlying the R compliance was rejected by committee in March 25, and we have taken which was the cybersecurity policy. So this has been taken back, and officers and Aon have looked at it. Unfortunately, we received the finished product after the committee papers had been submitted. So we intend to bring it to committee at the next committee meeting. But part of it is to streamline the policy and make it more compliant with what Councillor Mathers and Councillor Mills requested be more specific to our needs. And on top of that, a cyber hygiene policy guideline has been developed as well. So this will provide training for members and both committee members, board members and officers on how to adhere to strict cyber guidelines, and in terms of using your laptops, websites, visiting websites. So this training will be provided once the policy has been ratified at the next committee meeting. So, and in terms of the compliance, our compliance has been shifted forward, as agreed by the Pensions Board, to March 26. So, and the main aspect of it is the cyber policy and the EDI, Equality, Diversity and Inclusion Policy, which have both been revised and will, once approved, will form the main basis of our compliance. Thank you.
Councillor Reeta.
Thank you, Chair. And I do want to thank officers for their continued work on improving and updating things so that we are compliant and future-proof, as it sounds. If I may, just an ask that, thank you very much for detailing the training that's been undertaken, and it would be really useful to know what planned training was coming up roughly. So, for example, if I need to go and do extra hours elsewhere, I need to go and do those extra hours. I'll probably do them anyway, but it's that kind of extra hours. So if I know there's another 5 or 6 hours coming up in the next sort of 6 months, then I know how much I need to look for externally. Just a guide, nothing fixed, but just lets us know what we expect to do as a committee and then what extra bits we need to seek. Thank you.
I think, if my memory serves me well, Tunde, you already started doing that, haven't you? I think you sent out last month we had some civ trading and stuff due, and he's been sending it out. Is everybody, are you receiving that? Councillor Bassett, are you receiving that as well? Yeah?
Yeah, so I will continue to send out training opportunities that as they arise, and I think there should be a few more in the next couple of months, so I'll update members, both committee members and board members on those.
I think it's just been a quiet month, August, hasn't it? So we've not had a lot through.
Sorry, Chair, I was just thinking of the training that we do. So like we had Izio do I'm going to get what Izio did now, around the strategy, the assets. If we know that's coming up as we look towards, asset allocation, etc., if we know we're doing some in-house training, if we can just have that as a guide, like there's going to be 2 hours of in-house training on X or Y, then I know that I need to be looking out for the bits you're sending through if I'm going to be short. That was all it was. Just a bit of a guide of our in-house stuff. Yeah. Thank you, Chair.
Yeah, okay with that, Tunde?
Yes, Chair. I think the next training will be on the investment strategy once that's been produced, and that will be at least about a couple of hours. So we're looking, Andrew, I think we did agree on a time for that. It will be before the next pensions committee, probably in around October or November.
Lovely. Thank you, Andrew. I think, generally speaking, Tunde we've agreed it in advance when we're sending out the meeting dates and what dates are for all councillors to attend. So I think we send out several dates for you, but we'll continue that. But we'll take it on board, Councillor Mathers. So the recommendations are that we note the dates of the pension committee meetings, that we note the committee work plan, we note the committee's continuous CPD update, and then we note the GCOP update. Are we all in agreement with that? Agreed? Lovely. So therefore I will bring the part 1 of the meeting to a close nice and swiftly, and we'll move on to part 2 shortly. Okay, we're offline now. Does anybody need a quick comfort break before we go into part 2?